Welcome back, everyone, to my favorite time of the month. That's right, it is stocks to buy. This time for September 2019. Obviously, this is my favorite time of the month because I get to give out some recommendations of things I'm looking at that might be helpful for you to look at as well. So I'm going to be very happy to continue doing this monthly. So let's get right into it. First one, as you see right here, is going to be Tapestry. So as a little bit of background for Tapestry here, here's the description. Tapestry engages in provision of luxury accessories and lifestyle brands. It operates through the following segments: Coach, Kate Spade, Stuart Weitzman, and Corporate. So those are brands that Tapestry owns. So in general, this is technically a retail company. You're usually going to see a lot of these types of stores in malls. And obviously they have their online segments as well. So there's a couple of reasons why I'm looking at Tapestry this month. Obviously, brands like Coach, Kate Spade clearly are very in. They're always big brands out there. People are always going to be buying those brands. Something to look at. But my main reason that I personally bought this, and I did, this is one that I actually did purchase, would be a look at this 1 month chart. Let's just get an idea for when this beatdown starts. So obviously we're sitting high right here around the $30 range back in July. Let's go down to this 1 month chart so that way you know this is when the beatdown starts here. Yikes. That's an ugly 1 month chart, I can tell you that right now. So you go ahead and look at this. So starting at the end of the month, last month, right around $31, and right now we're sitting right around $20.50. So lost $10 a share, about 33% in value. That to correlate that, so it lost 1/3 of its value within half a month's period. Not even necessarily that, it was just one awful day here between on the 14th, where we went down from $25 to $19. So this stock's been beat down pretty hard. Now, I don't necessarily say that I'm purchasing this one for growth. I see this as a good dividend play, as well as you'll see that with the remainder of the stocks on this list. This is going to be a month of dividend plays. Obviously, we have this fear of recession, quote unquote, and people are going to flock to dividend stocks. Obviously, that'll increase its value, but overall, it's going to be good to ride out any sort of recession. Instead of selling, you want to ride it out with dividend stocks so you can just keep earning that income on the sideline. So Tapestry is certainly one of those that I think is worth looking at. Look at some of the financials here. It's posting a PE ratio right now of 9.28 thanks to this drop. Obviously, anything under 10 is a very undervalued company. Not necessarily saying that it will go up, because we've seen stocks that are stuck in that PE range for quite a while, but just saying that it's certainly not an overvalued stock, so it's going to be hard, in my opinion, at the current levels, unless something were to happen, to see it get devastated any further. Obviously, you would have to take a string of bad earnings, but I don't think that's necessarily going to be in the cards for Tapestry here. So right now, also with a yield of 6.58%, which is a fantastic yield, as highlighted there. 6.58% yield is fantastic, which correlates to 34 cents per share, or I believe it's 33 cents 0.75 is what it actually is. So they round that up to 34 cents here. So really it's 33 cents, 0.3375 cents is what I should say. So overall, that's it's a consistent dividend for them, so it's not like theirs is one that's increasing or decreasing. They've been consistently paying this same dividend for quite a while now. So it's something that you can see is pretty exciting because it's something they aren't clearly set on changing. I know obviously people want to see increasing dividends, but if you're yielding 6.58% already, I don't necessarily need to see an increase in dividends. So for me, this is a stock I definitely would consider looking at. If you're interested in a dividend player, which I would be if I were you, I'd say Tapestry is a good one to look at because it's got beat down so lately. So next up, we're going to go to Kohl's Corporation. Kohl's is one of my holdings I've had for quite a while, and I've decided now it's about time to pick up some more. Obviously up 2.99% today. Let's bump it up to 3. Why not? We're in the middle of a trading day at this point, so hopefully we can shoot up to 3% by then. But anyways, Kohl's Corporation, as most of you'll know, they're a retailer, big retail company. They own quite a few stores, clothing, accessories, home and beauty. So obviously they own these big stores. You see them in a lot of malls too, but they also own their own big stores on top of that. And obviously if you've ever been in a Kohl's, you know it's a pretty big building. So honestly, very exciting. Kohl's for me. We're going to look, get an idea of the 1-year chart here. Let's go further than that. So I've owned Kohl's for quite a while now. Back around 2017 is when I picked up Kohl's. And obviously, we saw a very big rise here, peaking somewhere around $81 a share, we'll say. And I picked it up for around $40 per share. I can go more into obviously my positions and stuff later, but in general, I'll just say I at the time had doubled my money, but I didn't sell out. Obviously, because Kohl's is a good dividend play for me, so I didn't sell out. And now we're back down to that $46 range, so that's what interests me in this. It's finally back down to near my cost basis, so it's not going to be too absurd to buy at these levels, and that's why I'm considering buying. I think it's a perfectly fair valued company, 10.14 PE ratio, pretty undervalued in my perspective, obviously because their earnings are increasing, they're doing pretty well. 5.83% dividend yield, or a 67-cent dividend. So this is a company that does increase dividend yearly, so that's something to look at as well. Obviously, anything around a 6% yield is something it's a juicy dividend, is what I would call it. And I'm always looking for those juicy dividends as long as they can back it up. And Kohl's is a company that can. There's a few reasons why I think Kohl's is going to be one of the retailers that sticks around. I know obviously this is a time of dying retail, whatever. But Kohl's is they're honestly doing whatever they can to stay ahead of the curve, and they're honestly have a great management team right now. I believe Michelle Glass is the CEO. And let's be honest, that management team is rocking it right now. So they recently announced a partnership with Amazon, where they're going to go ahead and allow for Amazon online returns to be processed at Kohl's locations, which obviously people might think, well, I mean, that's just a different company's returns. How does that matter? The thing that matters is you're getting people in the store, and that's what matters. If you get foot traffic in, a lot of the times people aren't going to, nowadays, people aren't buying stuff in department stores for the simple fact that they don't want to go out. But if they're already going out to process these returns, they're going to shop while they're there. You can't, if you're already out, you're not going to be lazy and then go right back home and shop online. You're already out in that store, you're going to be shopping, and foot traffic is everything when it comes to retail. The more people you bring in, the more likely you are to sell merchandise. So I think Kohl's is really poising itself for success here, and I think it is a company that can certainly grow, and it's certainly going to survive this retail apocalypse, but their online presence is also pretty persistent as well. So Kohl's to me is a good thing to look at, and you'll see here, obviously, why not? Cohen gives it obviously they cut it, but $58 price target. But overall, you'll see just by analysts, I hate analysts, but Pretty undervalued stock, and I think it's something I would certainly consider buying, especially at these levels. So, finally, we're going to go to Apple Hospitality. It's not normal Apple that you'll think of, but it is an Apple. So why am I looking at this? Apple is a real estate company. So they own the brands of Marriott, Hilton, and Hyatt. So they own hotel locations, which is obviously a segment that is it highly depends on time of year is a factor, as well as the economy itself. So I think obviously the economy is still going well. People are definitely making enough, especially with wages increasing. People are making enough to stay at these places, not just rich people now, but people can stay at a Marriott or a Hilton or a Hyatt now, and not have to worry about breaking bank usually, just due to the fact that the economy is really pumping right now. We're still growing. People are having wage increases. Unemployment's so low. I think overall Apple is poised to make success on this rent money. Obviously, that's how they operate. It's hard to judge a PE of a real estate investment trust like this. They show a PE of 18.12. That's not necessarily what I would consider looking at when looking at an REIT, but or REIT, as people say. I hate calling them REITs, but I just call them REITs. Anyways, I think that Apple's a good stock to look at. It's a pretty consistent player. We'll just look at the I didn't mean to click 6-month year-to-date chart. Obviously, we'll go further than that. I think we all want a good picture. We want the full year from last year. Somewhere around $18. Had a big old dip there. You already know I purchased some more right around there. And then we've been consistently sitting around that $15 range, $15 to $16 range. So overall, it's not necessarily a big mover, either up or down. Not the greatest looking 3-year chart, but I'm not in it for growth. I'm going ahead. Let's look at the all chart. That's just something to look at. That's exciting. Well, anyways, I'm in it for dividend. And you can see here a 7.63 yield at the moment and a 10-cent dividend. They're another one of these companies that pays a consistent dividend. They've been paying 10 cents forever. No matter what's going on, they're paying 10 cents, and the yield always fluctuates based off that. They don't increase their dividend, but their yield might increase depending on that. So frankly, I think this is a great consistent income earner if you have enough money in here. Just think about it. 10 cents every month they pay monthly, which is why I love them as well. The other companies pay quarterly, but Apple pays monthly, which is exciting. So every month you can go ahead and give yourself a little bit of extra money. That's always what I consider exciting. I don't know about you, but just consider if you have 100 shares of Apple Hospitality. Every month you're getting yourself $10. Go ahead and buy yourself a nice meal. You get a good old 2 $5 biggie bags at Wendy's. And you can actually have the spicy nuggets now while you're at it. Why not? Love those spicy nuggets. That's all I got for you today, though. So go ahead, pick up some spicy nuggets from Wendy's. I suggest them as well. That's also my final. Wow. I lost the words. My final recommendation on what to buy this month: spicy nuggets from Wendy's. Treat yourself, then treat yourself to some of these stocks. All right. Have a good one.